Hi, and welcome to my monthly market insights video. My name is Dan Timotich, and this month we're going to do things a little bit differently. I've had a number of questions about how to manage your income needs in a low interest rate environment, so I thought I would share some ideas and hopefully put things into perspective on how you can better allocate some of your investments. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, so look, when interest rates are on the higher end of things, there is a good opportunity to hold fixed income securities to meet your income needs. But when interest rates are low as they are today, you need to be really mindful that you could potentially lose some value in your bond holdings as interest rates as they increase. Now, generating income, it's a delicate balance. It requires experienced portfolio managers to make changes based on market conditions. The experience of going through different interest rate cycles, credit cycles, market cycles, that's all important in order to understand the environment we're operating in. I think investors have been told for too long to simply buy and hold. It is what it is. But if you don't have different strategies to meet the demands of the current market environment, you could be in for some real surprises at the end. So what we're going to do here is we're going to take a look at two different investments, both of them that pay monthly distributions and how they perform on a one-year holding period. The first one we're going to look at here is BBN. It pays 6.7% annualized on a monthly basis. And let's assume you have $10,000 to invest and what happens over a year. Your initial investment of $10,000 has a final value of $9,689. Over the course of the year, you'll receive $670 in income, but you'll have a capital loss of $311 at the end of that year. The net result is $359 or 3.59%. Now let's compare this to another bond ETF. This one's PGHY. It has a lower annualized distribution rate of 5.29%. And your same $10,000 investment a year later would be worth $10,153. Over the course of a year, you're going to receive $529 in income, but you would have had a capital gain of $153. The net result is $682, or a total return of about 6.82%. So the reality and really the summation of this is that just because an investment is paying you more on a monthly basis doesn't necessarily mean that you're going to be better off a year later. BBN paid you more each month, but it cost you at the end, and PGHY paid you less each month, but made up for it in the end. The reality is that investors need to be paying attention to both the income an investment generates and the potential for capital gains or potentially losses that you may have at the end. Keep in mind, PGHY gave you nearly twice as much money as BBN did, but had a lower monthly distribution rate. So hopefully this will shed some light on how to balance some income and capital gains to you, and hopefully it'll help frame your portfolio a little bit better. Now, let's go into the review and outlook for the month of September. We had a pretty good month for large caps. Small caps struggled a little bit, and long-term treasuries continue to underperform just about everything. As you can see for the year, stocks have done much, much better than bonds and are overweight to stocks, and the fact that I thought stocks were a better option throughout 2018 has really started to pay off. From a sector perspective, we're starting to see, we continue to see discretionary stocks, consumer discretionary and technology leading the way for the year. This is really nice to see. I want to see consumer stocks doing well, particularly since 2/3 of our economy is dependent on consumer. This is a really welcomed result for the year, as well as for the month it was pretty flat, but for the year it's doing really well. So looking at my four-part framework, I'm still very positive on the economy. I think we're going to continue to see strong economic numbers. Earnings, profit margins are great. We're entering third quarter earnings season, and we expect to see strong earnings as well. On the valuation side, I think valuations are fair, not too cheap, not too expensive. As long as earnings come in as expected, I think we could justify these valuations. But with the 10-year crossing above 3%, I just want to remain neutral. And in terms of the markets have been great so far this year. They're holding this uptrend. They're hitting all-time highs. The reason that I'm neutral here is that it appears that markets have shrugged off almost all sorts of potential problems. But as we enter into the midterm elections here, there's going to probably be some angst, and I just want to be neutral depending on how the election outcomes end up in November. So what are we doing now? I still overweight the U.S. stocks over international stocks. I still like credit risk over interest rate risk, but given that interest rates have backed up a little bit, I'm starting to move to more of a neutral or a balanced approach between credit and interest rate risk. I would be patient going into third quarter earnings here and into the elections. There's really no reason to make big bets at this point in time, so I would be holding diversified low-cost exposure to all asset classes. So I hope you enjoyed this month's video, and as always, if you have any questions or you want any follow-up, please feel free to give me a call. I'd love to hear from you. Hope to see you next month, and enjoy the rest of your month.